Most traders have heard of the Fibonacci retracement, but almost no one uses it correctly. And that's exactly why they keep missing perfect reversal entries and continuation trades that institutions quietly capitalize on. In this video, I'm going to change the way you look at Fib levels forever. You're going to learn how to pull the Fibonacci the right way, how to identify high-probability reversal setups, how to spot continuation setups inside trending markets, and how to combine Fib levels with Confluence so your entries become more accurate, more precise, and more consistent. By the end of this video, you'll know how professionals actually use the Fibonacci tool. Not the way textbooks teach it, but the way smart money trades it in real charts. What is Fibonacci retracement? Fibonacci retracement is one of the most powerful tools in technical analysis. Yet most traders only use it on the surface without understanding the deeper logic behind why it works. To really grasp its importance, you have to understand where it comes from. The concept originates from Leonardo Fibonacci, a 12th century Italian mathematician who discovered a numerical sequence that appears repeatedly in nature, biology, art, architecture, galaxies, and even human behavior. This sequence, 1, 1, 2, 3, 5, 8, 13, 21, and so on, creates ratios that we call Fibonacci ratios or the golden ratio. Over time, mathematicians uncovered that these ratios describe natural growth, balance, and proportion better than almost any other mathematical system. Surprisingly, financial markets, driven by mass human behavior, also react to these same ratios because crowd psychology follows patterns of fear, greed, impatience, and profit-taking that align closely with Fibonacci proportions. So when price trends upward or downward and then pulls back, it doesn't do so randomly. It often retraces to precise Fibonacci levels because these levels represent zones of psychological equilibrium, areas where traders take profits, institutions accumulate orders, liquidity builds, and algos execute buy or sell programs. Many trading algorithms used by banks and hedge funds have Fibonacci ratios coded directly into them because the market itself naturally breathes in Fibonacci rhythm. This is why you'll often see price reverse, bounce, or consolidate around certain levels. It's not magic. It's a mathematical reflection of market psychology and liquidity distribution. Among all Fibonacci ratios, certain levels carry more weight. The 0.382 level represents a shallow retracement, meaning the market is trending strongly and buyers or sellers are stepping in early. The 0.5 level, even though not a real Fibonacci number, is psychologically powerful because it represents a midpoint correction, where half of the previous move is retraced before continuation. The 0.618 level, the golden ratio, is the most respected by institutional traders. This is where major accumulations or reentries often occur because it represents a deep but healthy pullback. Then there's the 0.705 and 0.786 levels, two of the most advanced Fibonacci ratios used in smart money concepts. These levels capture deeper retracements where liquidity hunts occur. Price dips below obvious support or above obvious resistance to trigger stop losses, gather liquidity, and then reverse sharply. These deeper levels are highly effective because they represent trap zones, areas where the market manipulates emotional traders before continuing the original trend. Drawing Fibonacci retracement correctly is one of the most crucial skills in technical analysis, yet it's also one of the most commonly misunderstood. The accuracy of your Fibonacci levels depends entirely on selecting the correct swing points, which represent the true extremes of market movement. In an uptrend, you always draw the Fibonacci tool from the swing low, the point where buyers decisively stepped in, to the swing high, the point where the bullish move completed before pullback. In a downtrend, you reverse the logic, draw from the swing high to the swing low so you can measure the depth of the retracement upward. Traders often make the mistake of drawing their fibs on small internal swings, random wicks, or minor pullbacks that do not represent structural turning points. This leads to inaccurate levels and misleading signals. A valid swing point must show a clear rejection, displacement, or structural shift, meaning it stands out visually on the chart and represents a true pivot where order flow change direction. Another common mistake is drawing fibs incorrectly on wicks. The market respects liquidity, and liquidity is taken at wick extremes, so your fib must always connect wick to wick, not body to body. The context of the market also matters greatly. Fibonacci retracement works beautifully in trending conditions because the pullbacks are organized, measurable, and driven by algorithmic behavior. But in choppy, sideways markets, fib levels lose reliability because the price constantly whipsaws through multiple levels without respecting a clear structure. This is why you must always first diagnose market structure, trend, or range before applying Fibonacci. When used correctly on proper swing points within a trending environment, Fibonacci retracement becomes one of the most precise tools for identifying entry zones, confluence levels, and liquidity pockets. The very next thing is confluence. These Fibonacci levels become far more powerful when they align with other high-probability market signals, and the three strongest forms of confluence are trend direction, order blocks, and fair value gaps. The first and most crucial layer is trend alignment. Your Fibonacci tool should always be drawn in the direction of the market's dominant flow. In a bullish trend, you pull from swing low to swing high after a confirmed break of structure. In a bearish trend, you pull from swing high to swing low once the market has broken down. This ensures you are using Fibonacci to enter pullbacks within the trend, not fighting momentum. The second major confluence is order blocks. When a Fibonacci retracement level overlaps with a fresh bullish or bearish order block, the probability of a strong reaction increases sharply because you're combining algorithmic retracement behavior with institutional footprints. These zones show where banks previously executed large positions, and when price retraces to a fib level sitting inside an OB, it often becomes a high-quality entry. The third layer is fair value gaps, FVGs, imbalances in price created by aggressive institutional moves. When a key Fibonacci level lands inside or directly touches an FVG, it signals that the market may want to rebalance that inefficiency before continuing. This makes the fib area even more powerful because you're trading at the intersection of trend momentum, institutional order flow, and price imbalance. The most accurate Fibonacci setups occur when all three confluences stack together. The retracement is trend aligned, the level sits inside a clean order block, and it overlaps with a fair value gap. When these three factors combine, you're no longer taking a basic fib trade. You're entering at the same zone smart money uses to position themselves. Mastering Fibonacci retracement isn't about memorizing ratios. It's about understanding how price truly behaves. When you combine Fibonacci levels with trend direction, fresh order blocks, and fair value gaps, you stop guessing and start trading with precision.